And joining us now, Paul Summerville, Senior Fellow at the Center for Global Studies at the University of Victoria. And it's good to have you off the left coast and back in central Canada. How you doing?
I'm great. Nice to be back.
We have some memories of this studio, you and I.
We do. We were 5 sessions last year.
5 sessions last summer, and you were part of an all-candidates debate going back even a couple of elections ago.
Was it this studio here?
It was in this studio.
Oh, my goodness, with Peter and Carolyn.
Peter Kent, Carolyn Bennett.
One's a cabinet minister, one's still in Parliament, and I'm living in British Columbia, so there you go.
Three good news stories.
I hope so.
We're going to talk about 3 things. We want to talk about what's going on in Europe right now and how fragile the economy is there. We want to talk about what inflation is doing with some of the more robust economies around the world. And then we're going to talk about Canada a bit. And to get it started here, I want to read a little piece that Paul Krugman had in the New York Times a couple of weeks ago. He says, "In a way, I missed the months that followed Lehman Brothers' failure." Okay, not really. But if it was a time of terror, it was also a time of clarity. The whole world was going to hell in a handbasket, and policymakers everywhere shared a common goal: stopping the plunge. Today, by contrast, the picture is full of seeming contradictions. Are we in a runaway boom, or is growth weak? Is inflation low, or is it spiraling out of control? The answer to all of these questions is yes. In short, at this point, we're living in a world that is characterized not so much by the sum of all its fears as by some of all fears. Whatever you're afraid of, be it inflation or unemployment or fiscal crisis, it's happening somewhere. But the problems are different in different places. Okay, Paul, lots to unpack there. Let's start with this. Lots of investor fear out there that some important European countries just can't manage their debt anymore. And I wonder if you could sort of help us understand what is setting off this latest round of jitters in particular.
Well, a little bit like we discussed last summer, as far as Europe is concerned, there was this exercise to create a unified European economic zone. The truth is, this is really a political experiment that masquerades as being economics. The political elite in Europe has always been desperately afraid that Europe would fall back into the civil war of the first half of the 20th century. And there's a strong consensus among that elite that a European Germany is better than a German Europe. And this has driven for 50 years this experiment of European Union, which then flowed through into the creation of a single currency. The problem was that when the single currency was created, the only way the Germans were going to come on side was if the anti-inflation policies of the Bundesbank, which are rooted in the hyperinflation of the 1920s, became part of a European central bank. So everybody had the same central bank and therefore the same level of interest rates, at least officially.
Which has taken some sovereignty away from other countries and the ability of them to do their own thing.
But if you were Greece, or if you were Portugal, or if you were Italy, you were really happy about that. Because for a while, investors were prepared to believe that the interest rates that Germany had could be extended with a slightly elevated level to those countries. The problem with this political experiment, which economists like Jacques Delors, who helped set up the European Union and the Euro, the myth that they peddled was that these countries could all have independent fiscal policy, that every country could run their own shop at home.
And we're learning they can't.
Well, and because economists basically believe that markets are rational and that economies are culturally neutral. In other words, you just take a picture of GDP, what's investment, what's consumption, what are prices, and they're all the same. Well, they're not all the same. And what we discovered was, for the first 10 years of the Euro, countries like Greece and Portugal and Ireland and Spain went out and borrowed money at levels slightly above Germany, and then they levered them into corrupt and insolvent financial systems like Greece, and huge property booms, which have occurred in Portugal, Spain, and in Ireland. And now it's coming home to roost.
Well, let me follow up on the Greek angle here. They've announced plans, I gather. They've found an additional 6 billion of cuts, 6 billion euros of cuts. They are starting a $50 billion privatization plan in order to realize some more income to deal with the bondholders and their debt. Is that a good start?
Well, the problem Greece has is that every time they try to do something that improves the situation, at least to economists, or anytime some of the Euro countries stand up and try to bail them out, the straitjacket gets tighter because they're in a currency straitjacket. The Euro goes up in value. What Greece needs is a devaluing currency like Canada did in the late 1990s when it was going through its fiscal problems, like the United States has done to its currency over the last 2 years, which has occurred to the pound.
But they can't do it.
Greece can't do that. So they're trapped in a fiscal and in a currency straitjacket that they can't get out of. I don't think there's any prospect at all for Greece to get out of this while they're in that straitjacket.
So Greece is insolvent.
Greece is insolvent, that's right. And the way I like to think about it is there's a difference between a liquidity crisis and an insolvency. Let's say your house is on fire, you've had a car accident, your family's ill, and you need $15,000. You go to the bank and you say, I don't have $15,000 right now, could you lend it to me? And the banker looks at you, you must have a good job, gives you the money, because he knows you're going to be able to pay it off. The problem is that you don't have a job. And now, also, a bunch of other people have lent you the money, and they don't have jobs either. And that's the problem in the Eurozone right now, because Greece is incapable of raising the revenue to pay these debts off, full stop.
On the other side of the spectrum, let's talk about some of those countries that we like to call the BRIC countries, which are doing pretty well. China and India last year, growth rates 10%, Brazil more than 7%. But I gather there are fears now that such hyper-growth will lead to inflation. How real a concern is that?
Well, it's a big concern. And the real core, of course, is China. And so it's very important to go back to understand the genesis of why we're having the inflation problems in China today. In 1997 and 1998, in fact, came on this show, talked about the Asian crisis. South Korea, Indonesia, China, all of these countries had the IMF come in and read them the Riot Act about how to reorganize their economies, particularly South Korea. All of these countries said this is never going to happen again. And what they've done is they've consistently kept their currency low in order to generate current account surpluses and large pools of capital to create a buffer against any problems in the global economy. But by keeping your currency low, you're essentially importing inflation. Now, in China's case, as long as you're bringing 600 million people from the countryside who are making $1 a day to bringing them into making, say, $15 a day, as long as you have that pool of labor, that's sustainable. But that's coming to an end for China as we're going into the 14th or 15th year of this exercise. Wages in China are going up now 15–20%. And so China is at a clear moment of decision.
Because that's not sustainable.
That is completely unsustainable, particularly as you continue to want to run current account surpluses by keeping your currency low. So China's elite is very concerned about this, and the reason is that there are inflation episodes in Chinese history that created unstoppable political change, 1949, 1911, and the mid-1850s. And as you know, the Chinese are very familiar with their history. You've seen, for example, recently the arrest of Ai Weiwei, who's a famous artist. There was a statue of Confucius that was taken down in front of the National Museum in Tiananmen Square. These are all signs that the Chinese are very nervous about the political cost of inflation. And over the last 6 months, the Chinese Communist Party has started to squeeze on the inflation bubble.
Is it working?
There are signs that it's working, but it's always difficult to get that genie back in the bottle, and usually you have to do more.
So if you like the idea of the Chinese Communist Party being in trouble and perhaps being overthrown someday, should we be cheering on inflation in China?
Go inflation, go.
Really?
Oh, absolutely. Chinese leaders depend on something called the mandate from heaven. And inflation is seen as something that's caused by the state. And I think that's actually why the Communist Party will be able to attack inflation very aggressively, because ultimately inflation is a worse problem for China than unemployment.
Translate a little economic ease for us, if you will,
Sure.
here, because Paul Krugman also in that piece wrote that Russia, Brazil, and China don't have to have inflation if they don't want it, since they always have the option of letting their currencies rise against the dollar, the American dollar, we presume.
Right.
What exactly does that mean?
Well, that basically means that their currency, as it rises, allows them to buy commodities that are priced in the US dollar for less amount of money. So instead of having to use, if a price of oil, a barrel of oil is say $100 a barrel, they can buy it a lot cheaper if their currency rises, and that puts deflationary pressure in their economy.
Are we so globalized an economy right now that if China and India are at 10% growth rates and the inflation that comes with it, and Brazil is at 7% and the inflation that comes with that, that we're going to feel it here?
Canada's heading for a brick wall.
A brick wall, pun intended.
No, a brick wall, not pun intended.
No pun intended.
Sorry, yes, with a C and a K rather than B-R-I-C-K.
What does that brick wall
look
like?
Well, basically, the Canadian economy over the last 10 years has benefited tremendously from this commodity boom. Canada's, the market capitalization of the equity market in Canada has risen in terms of oil and minerals about 15% to 40%. If you look at the components of Canada's exports, it's doubled over the last 10 years in terms of oil and minerals. So Canada's benefited tremendously from this commodity boom, and you've seen it in the rise of the currency. This is probably a really good time if you think the Chinese are going to be able to turn the inflation bubble down to short the Canadian dollar against the US dollar, because Canada will feel the downturn in commodity prices.
But if you took the rising price of gas out of the basket of things that we consider when we figure out what the inflation rate is our inflation rate still where we'd like it to be?
Well, the central bank, every central bank has different ways they like to think about inflation. If you look at this basket, which doesn't include food and energy, then inflation doesn't seem to be a problem. But most people you talk to, that's the first thing they think about.
Of course.
Right? You ask anyone how much they paid for a gallon of gasoline, they can probably tell you within a penny.
No, they can tell you about a liter, not a gallon.
A gallon, sorry. They can tell you within a penny. The risk then is that they change their consumption because of rising prices.
U.S. debt. At what point, they're running deficits, I guess the last few years, of about $1.5 trillion a year. A lot of money. At what point do you think the United States needs to get supremely serious about dealing with that debt before some chickens come home to roost?
Well, they're pretty close. They're pretty close. A lot of the debt problems that the U.S. faces are pushed out a little bit because it's really entitlement that creates these huge levels of debt for the U.S. The truth is, though, that if you look at the United States, they do have the option of raising taxes. If you look among the OECD countries, the U.S. is one of the lowest in terms of tax revenue as a percentage of the economy. For example, in the U.S., it's around 25%. Canada, it's about 35%. So they've got room to raise taxes.
They won't do it, though. Zero political will to do that.
Well, it depends at what point the crisis occurs. So if they did it sooner rather than later, that would be better. I've certainly written that the risk is that the markets will have to force the hands of the United States in that respect. For example, if the U.S. had a VAT, a national consumption tax, they would eliminate their deficit in one swoop. But we know that culturally the U.S. is very, very uncomfortable about raising taxes.
In which case, you've got some Republicans right now who seem prepared to kind of burn the barn down in order to find savings. You've got some Democrats who, you know, are all too happy to continue to prime the pump. Where exactly does political America find the balance to make this happen?
The political cost of shutting down the government was really bad for Newt Gingrich and the Republicans in the mid-1990s. They kind of set up another Clinton presidency. So they've kind of learned from that lesson. Like we just saw a few weeks ago with the whole idea of the debt ceiling. The risk is they'll take it right to the last minute. Obama, they've kind of put the number on the table, which is $4 trillion in spending cuts. And then how do you get to that? Do you get it through spending cuts, or do you get it through tax increases? I don't think anyone really knows. It is a bit of a throw of the dice. But I think the experience in the mid-90s of what happened to the Republicans when they shut down the government will give them pause before they try to go down that path.
But I guess one of the things people are trying to figure out is America, which it always has been, so dynamic and so prosperous a place that they'll grow their way out of this or figure their way out of this eventually at the 11th. They'll figure it out eventually. Or is this something different right now?
Well, it's different because they have so compromised their financial sector and left themselves with a structurally flawed labor market and a deflating housing market. And this is why Bernanke continues to say that he's going to keep interest rates low and why he claims not to be too worried about where inflation is. If you look at what's called the job participation rate, the number of people that work relative to the labor force, it's the lowest level in 45 years. The U.S. housing stock, right now there are 18 million empty homes in the United States. That is 30% larger than all of Canada's housing stock. So there was a huge bubble in consumption and housing that needs to be worked out. And when you layer on top of that the terrible financial damage that occurred between 2008 and 2009, it takes a decade to work that through. I would actually argue that it's more important for the U.S. to once again invigorate its immigration policy in order to try to bring more people, young people who want to come and work and get wealthy in the United States than what's been happening in the last decade. I think that's actually a bigger risk to the future of the U.S.
You only want to touch the third rails of politics, I can tell.
Well,
right?
you know,
VATs and crank up immigration.
It's probably why I'm not in politics anymore, Stephen.
I think you hit it on the head there. All right, well, just in our last minute here then, problems in Europe, problems in the United States, to a much lesser degree here in Canada. Can we find the balance to figure all this out, do you think?
Well, again, I think Krugman's article is very helpful in this sense, because even though we talk about a global economy, the reality is we've got very different political and cultural paradigms in which national economies work in, with very, very different kinds of problems. And this is what's coming home to roost in Europe with such momentum. And every country has got to work through this to come to their own excellent future at some point. Canada is a little cork, on this ocean. And as long as we continue to have thoughtful immigration policy, we're continuing to be thoughtful about how we invest in public education, Canada should be able to work its way through. But it's going to be a bit of a bumpy ride the next 6 to 12 months.
Now, that was not a coincidence that you said excellent future, right? You're doing a plug there.
That was a plug for my book, Canada's Excellent Future.
There you go. I just wanted to give you a chance to get it in.
Thank you.
Paul, thanks a lot for coming in today. We always appreciate your visits. And, of course, next time you're back in town, let us know. We'll have you back.
Pleasure. Thanks so much for having me.